Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Currencies can actually, of course, cut both ways. During the credit crisis, the dollar strengthened against just about all the currencies, I guess, maybe one or two. The yen was actually probably the strongest. But U.S. investors that had international investments had currency drags on their investments. Non-U.S. investors that had U.S. investments, though, had currency tailwinds, right? If you were here in the U.S. and the dollar's rallying, well, we know the markets were going down, but it was better here if you were invested in the U.S. because the dollar was a bit stronger. During 2009, the reverse was true, and sort of weird how it's 2008, dollar strong, 2009, dollar weak, and now 2010, dollar strong again against many of the currencies. It really depends, so it's not as easy as it was during that period when we saw, because we know if you're following the Australian dollar, it's relatively strong, Canadian dollars, so the COM dollars are pretty strong. Obviously, Europe is very weak, and I'll show you some charts on that in just a little bit. European currencies are weak, whether it's the euro, the Swiss franc, British pound. They are weak relative to the dollar over the last 5 or 6 months. In fact, the dollar bottomed around Thanksgiving, so in November of 2009. At least the short-term bottom. So what's the purpose of currencies? Well, the purpose of currencies is to facilitate trade between countries. If importers or exporters have an imbalance of currency relative to another, the spot currency market can be used to regain their desired level of equilibrium. Different markets to trade currency, so you can trade through what's called a spot or cash account. You can trade futures. You'll need a separate account for that, and you'll obviously need a separate spot account or cash account. And the options that we trade at the ISE, well, you just need to be options enabled. So options allow you to have limited risk. So last week, obviously, was a great week for options because the limited risk, even if you were wrong, you benefited from the fact that volatility was moving up. So in volatile times, buying options, if you're going to know when those periods are going to be what you'd like to do. If we were to know that volatility was going to decline over the next couple of weeks, months, or even years, you want to be a seller of options. They're doing a strategy called credit spreads. So you can tailor the risk to your own needs. Very, very important. Can't really do that in the spot market. Can't do it in the futures market. You can do it in the options market. So there's tons of ways to create your own unique payoffs. What are these options? Well, they're bilateral contracts. They allow you to have, if you long the option, you have rights. If you short the option, you have obligations. So the person that buys an option pays a premium. The person that sells an option gets the premium but has an obligation to buy a particular asset at a specified price and date. Buyers pay premiums, but they have limited risk. Sellers receive these premiums, but they have substantial risk. They're all cleared by the Options Clearing Corp. So we don't have to worry about any OTC trades. These are actually cleared by the largest clearinghouse in the world. You will need an equity options brokerage account, so if you can trade options on Microsoft or Google or Apple or IBM, you can trade options on the ISE currency options. So these are trades that are done at the ISE. In fact, our trading hours are now, they've been expanded to 7:30 Eastern time, so we added 2 hours in the morning if you'd like to see the markets open earlier, and if you're watching the markets early, well, that's another reason you might want to trade these options. How are the options determined? Well, the pair value, the strike price, the time left, the interest rate differential, and volatility. Those are the 5 factors that go into the price of the option. We have European style, which means that you cannot exercise them early. Don't fret, though. Just because they're European style, it doesn't mean you have to hold them till expiration. You can close them out anytime you'd like, as long as the markets are open and, of course, that there's still a bid. There's always going to be an offer at some price, but there's not always going to be a bid. If you wait around too long, a worthless option might not have any bid. Cash settlement, what does that mean? Well, it means that the option is going to settle back into U.S. currency. So, for instance, if I bought a call on the U.S. dollar, Canadian dollar, at, let's say, 100, and it closes at 101, the 100 call would be worth at 1 point times $100, because that's what the multiplier is for all these contracts, for all option contracts. You have that 100 multiplier, and you get that you would receive $100. Now, you might have paid $200 or $300 or $400 for it, and so you have to consider what you paid for the option. The dollar is relative, so when you're trading currencies, it is a relative game. So U.S. dollar is per U.S. dollar is in the numerator, and I'm going to show you some examples of not only U.S. dollar base, but U.S. dollar quote. We have both we have both conventions, I should say. U.S. dollar in the denominator, we have those at quote. We have 4 of those, and I'll show you those. And dollar base or quote convention determines the selection of either calls or puts. So think of it this way. If you have a view, of course, we hope you do, have a view on a certain currency, you're going to have a view sort of that currency versus the dollar. Then you're going to decide, okay, what is my view on the base currency? So if I'm trading the U.S. dollar against the Canadian dollar, I'm bullish on the U.S. dollar, I'd be looking at quite possibly buying calls and maybe selling puts. If I'm looking at the euro against the dollar and I was, let's say, bullish on the dollar, well then I would be buying puts because I'd be bearish on the base currency, the euro. Of course, we all have to form our own opinions, and how you do that is up to you. You can go to the ISC site, which is actually the FX Options, fxoptions.com, and we have tons of tools there to help you form your view of the market. FX calls are the right to own the exchange rate, and puts are the right to sell the exchange rate. When considering options strategies, think in terms of, again, of the base. So if you're bullish on the base, you might want to buy calls. If you're bearish on the base, you might want to buy puts. There are tons of strategies. You could do vertical spreads. You can even do volatility positions.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.isc.com/podcasts.